My name is Rick Garber. I'm a mortgage loan officer, and I've been in the business for a little over 25 years now. Pre-qualification is the first step that you would take towards a mortgage. It's to gain an understanding of how a bank is going to look at your finances and to get a feel for what you're comfortable with on a monthly basis. Before a buyer feels confident in making that first offer, they should go through the process with both their local realtor and loan officer to get a feel for properties in the area and get a feel for how a bank is going to look at their finances. The buyer should have a budget in mind of what they can afford before starting the process, because there are so many components. It's not just the down payment, but what their monthly payment will ultimately be, what they'll need to come up with in closing costs, attorney fees, and so on. The two primary mortgage options are fixed rates and variable, or also known as adjustable rate mortgages. The fixed rate is very straightforward. You would choose a term 15, 20, 30 years, and your rate is just fixed throughout the lifetime of your mortgage. On the variable rate, your rate is fixed for a shorter period. So it may be fixed for 7 years or 10 years and then could adjust on an annual basis after that. And that would make sense for somebody that's looking at more of a starter home, or they think they may relocate in 5 to 7 years. In a case like that, a variable rate could save you tens of thousands of dollars. Interest rate versus an APR is the interest rate is a set rate, and it's the rate that you will be charged throughout your mortgage lifetime. The APR is a shopping tool that when you're first looking for that mortgage, you'll compare the APR from bank to bank, because it could be the same rate. It could be 3.5% for every lender, but the APR will show you any additional closing costs. It's a formula that takes both the rate and additional costs and builds it into that number, and you can compare which bank is more costly than the other. There are options out there for first-time homebuyers. Many of them are connected to affordable programs, which means there may be income restrictions. But if you do qualify for these programs, you could save on rate, you could save on closing costs, and potentially even save on the PMI, or the private mortgage insurance. First-time homebuyers should take a certified class. Certified classes typically last for 4 weeks. You go one night a week for about 2 to 3 hours, and you'll meet everybody from closing attorneys to realtors to bank representatives to representatives from your local affordable programs. There are a couple of ways actually 3 ways for a buyer to start the mortgage process. Once they have an accepted offer and they're ready to start with Cambridge Savings Bank, they've got the options of starting an application over the phone. They could set up an appointment in person, or they could do an online application. A borrower should allow about an hour for the initial application process, and that's everything from going through the application questions, documentation, and any questions that they may have. Often a buyer will reach out to a realtor first, but I would recommend to reach out to a loan officer first to make sure they have an understanding of how they would qualify, how much they would qualify for, and what price range they would be comfortable with. A lender is a good resource to help find a realtor. We deal with realtors on a daily basis, and typically we will give a buyer 3 recommendations for a realtor to find out who is the best fit for them.
Vivian Miranda, Mortgage Loan Officer at Cambridge Savings Bank.
Catherine Chav, Senior Residential Loan Analyst at Cambridge Savings Bank. So processing means getting an application from the mortgage loan originator, checking it, making sure we have all the information that we need from the borrower, disclosing that file. So that means sending disclosures out. When we get signed disclosures back, we ask for income documentation, asset statements, any other documentation that we may need. Once we receive that documentation, we order your appraisal, your title order, and then we send your file into underwriting after we review and make sure that we have all the documentation that we need. So we basically, from the beginning, make sure we have all the documentation that the underwriter is going to need to decision the loan file. So processing can take anywhere from 30 to 45 days to 60 days, depending on the type of transaction that you have. Typically, we see our refis take maybe like 30 to 45 days. We do have some quick close purchases that can go 30 to less than 30 days. Our mortgage loan officers will work with the borrowers to decide, based on what they're doing, what type of transaction they're doing, how long they should lock their loan for. So we call that the rate lock. So that will also determine how long we're processing your application for. Buyers should expect that we're going to be asking for documentation. We're going to expect it in a timely manner. And, if we have any issues getting the documentation, we're going to be reaching out to the mortgage loan officers to get in contact with you to, kind of speed the process up. We like to do this fast. And, if that's not happening, then, we're going to escalate to the loan officer.
Loan analyst and a mortgage loan officer have to work together because the loan analyst is the one that's going to put the package together to get it through the process. My job as a loan officer is to get the information on the rate and the program and get the lock and make sure the customer has particular expectations. And then when we hand it off to the processor or the analyst, that's their job to do, get the rest of the information, and then it goes to the next step.
Yeah, and we work together because it's just, we have to. We have good relationships with our loan officers, and they're always there for us.
If the loan officer sets it up properly, then they go to the analyst. The loan officer has to set the expectation on what's going to happen. We set it up A, B, C, D, E, what is going to happen through the process, so that when they get to Catherine or one of the other analysts, they understand what she's asking for. And again, if they have questions, we do work together, so they'll come back to, either one of us and ask again.
Customers typically get confused with our loan disclosures, and something that they really hangs them up on is the loan estimate, which is basically a breakdown of estimated fees that they could expect they're going to incur during the loan process. So we always encourage people that if they don't understand, to give their loan analyst a call, or even sometimes give their mortgage loan originator a call if they have any questions based on what they're reading. A loan administration fee is basically a processing fee. We collect $500 upfront once you've signed your disclosures. That pays for any money that's been spent upfront as part of your loan processing. So a credit report, a flood certificate, if we order an appraisal and your deal falls through, or you pull out of your refinance because you're going to another lender, that admin fee is going to pay for any money spent upfront. Typically, a client has to provide W-2s, a most recent pay stub, possibly tax returns if you are self-employed or you have rental income, expenses for any rental properties or second homes, and asset statements like your bank statements, retirement statements if you get a distribution from them. But that's typically all that we're going to ask for.
My name is Conrad Jackson. I'm a mortgage loan officer at Cambridge Savings Bank. I've been in the business for 12 years. A formal approval is a letter confirming that the banks review all your documents and are now comfortable in approving your mortgage. It's also called a mortgage commitment letter. A formal approval letter takes approximately 2 weeks, determined on how quickly the borrower provide documents. A credit approval letter is good for approximately 60 to 90 days. It's not always necessary to get one. However, if you're relying on the bank for financing purpose, it's best practice to customize that letter for the amount that you submitted in your offer for. We typically ask for 1 month of pay stubs and 2 years of W-2s. For special circumstances, when borrowers are self-employed, we ask for 2 years of tax returns.
My name is Matthew Longo, and I'm a mortgage loan officer here at Cambridge Savings Bank, and I've been in the banking industry for over 20 years. Typically, the documents that are required at the time of closing, the most important is proof of who you are, your ID, whether it's a driver's license or passport. You may be bringing funds to closing, so if you're purchasing and you still owe some additional funds for either the down payment or closing costs, you would bring that at the time of closing. Closing costs can vary from mortgage to mortgage depending on loan programs. Approximately 1% of the purchase price is what you should ballpark for closing costs and escrows. Those can be paid by yourself or negotiated to have the seller pay towards them. So it takes about 30 days to close a loan from start to finish. It can be done quicker. There are parts of the transaction that are sort of out of our control here at the bank because we rely on third-party vendors to do appraisals and title work. But in order to meet very tight timeframes, the best way for us to accomplish that is having the client meet all the dates as we direct them to. So the actual closing is really what I consider the fun part of the process because it's only takes about an hour, typically at a lawyer's office or a broker's office or the registry of deeds. The buildup of the entire process that typically takes about 30 to 45 days to get you to that point. Typically, I think clients are surprised to find out that they don't need to take a whole day off from work because it happens pretty quickly. So at a typical closing, you will see your lender, as well as the attorney and the realtors involved in the process, and the borrowers that are on the loan application. One of the most prevalent post-closing issues that come up is, where do I make my first mortgage payment and to whom? Loans often get sold off, and the first mortgage statement typically arrives after that first payment is due. How do I know when my job is done? Is when I get that clear to close from the underwriter. That's the most exciting day in the process. But as a loan officer, I feel my job is never done because I'm always looking out for my client's best interest in how I can help them in the future, whether it's a refinance or to purchase an investment property. So here at Cambridge Savings Bank, it's not just a one and done deal. We want to be your client and your bank for life.